Hello and welcome to this session. In this session, we shall learn about financial analysis. My name is CPA Peter Mugambi, and to do so, let me share my screen. Okay, welcome back. So again, we shall look at financial analysis and decision making. So first important is to understand what is financial analysis. Financial analysis is a set of knowledge, a set of skills in which stakeholders, both internal and external stakeholders, use so that they can be able to extract useful information for decision making from the statement of financial position. And then the key tools that the stakeholders use, both internal and external, to extract this information for decision making is a ratio analysis. In today's session, for the purpose of today's session, we shall look at the current ratio. And the current ratio is very important because it does help both the internal and the external stakeholders determine the liquidity of a company. And again, what is liquidity of a company? Liquidity of a company is the ability of the company to have enough assets to pay for its liability whenever they fall due. So for this, the stakeholders must know or have the skill on how to compute and, most important, also interpret the current ratio. Most important, again, like I mentioned, the stakeholders are not actively involved in a day-to-day learning of the company. Therefore, they are not aware of what is happening there, and they can only get this information or these numbers to compute the ratios through the statement of financial position, which have been published. So for the purpose of this session, again, we shall be looking at the financial statement for a chosen company, and the company in this case we are looking at is a Carrefour Group. So these are the published financial statements or financial report for Carrefour for the financial year that ended in 2021. We want to use this statement so that we can extract information for decision making, and in particular, whatever information we are looking for is information about liquidity of this company. And to achieve that objective, we will be looking, or we will be learning using the current ratio. So this statement, in the course of our study, we have looked at part of them, and then we shall keep on looking into more details about the statement so that we can be able to understand more and know how to extract this information. So to get the current ratio, we need to go to this statement, the consolidated statement of financial position. So I'll come back to this statement. Let me just go back again to my PowerPoint so that we can learn about the current ratio. So learning outcome, by the end of this lecture, you should be able to explain liquidity, which somehow we have already done. So we have explained what is liquidity, is the ability of the company to have enough assets to pay for its current liability whenever they fall due. And for you to be able to know whether a company is liquid or not, it is important as a stakeholder to have the knowledge about the current ratio. So that is the ratio we want to know, how to compute, how to calculate the current ratio, and most important, how to interpret the current ratio and extract whatever information we need for sound decision making. So liquidity ratios, they fall under three main liquidity ratio. We have the current ratio, we have the acid test ratio, and the cash ratio. Current ratio. So the current ratio, this is the formula. It's very simple one, very simple, whereby you take current assets and then you divide by current liabilities. What is most important at this point to know after learning how to use the ratio please you should take note about this formula, is how to interpret this ratio. And this ratio is usually presented as a factor. So this is the most favorable numbers. This ratio is presented as a factor, and a favorable ratio, whenever you compute it, then you should be able to find an answer of, the answer you find, it should be 2:1. So this 2:1 is what you are looking for whenever you calculate the current ratio. Why is 2:1? What does it mean? So these two here stand for the current assets that the company is holding. A company that has got strong liquidity will always have two assets held for each of the current liability it is holding. And this is most important because if the creditors come for their money to the company, which is in this case 1, then the company has a strong liquidity to be able to pay for all its creditors, and still it will be left with one asset to continue its operation. So again, that is most important to know, because once you calculate the ratio, you want to compare it with a 2:1. Let us see how this works for Carrefour. In this slide, we have an extract of the consolidated financial statement for Carrefour. Here you will see that this is 2020 and this is 2021. These are the non-current assets. When you are computing the current ratio, you only want to use the current asset, not the non-current asset. So you want to come here and see the number is the number here of current asset for the financial year 2020. The number here is 17,473. And then again for 2021, the number here is 17,783. So now you have already found your numerators, which you want to use when you are computing the current ratio, which I have just displayed, and we'll get back there. Again, the other key numbers you need is the current liabilities for the denominator. So here again is 2020, we have 21,342, and for 2021, we have 22,150. Now that we have found our key numbers, the numbers that we want to use when computing the current ratio, then we want to go back to our formula. And I have already done this computation. So for 2020, from the extract, you have seen that the current asset is 17,473, and the current liability is 21,342. So these are the key numbers. And once you compute that, you will get 0.817. So again, you want to present this number as a factor. So this is now the current ratio for Carrefour for the year 2020, which is 0.8187 into 1. Again, if you have followed that, I just mentioned that an ideal ratio would be 2:1. So from this viewpoint, then you'll be able to see that the Carrefour during the year 2020, it has a very low current ratio. And then again, we have computed for 2021. I take again the current assets from the financial statement for 2021, which is 17,785. And then again, I will divide this by the current liabilities, which is 22,150. And then we will get 0.829. And this number, again, as a current ratio, need to be represented into a factor. Most important, I want to insist that this number 0.829 represents the amount of current assets held in light of the current liabilities. So you can see that the current assets are less than the current liabilities, and this definitely, as an investor, as a manager, then you should be able to see that this is not a good sign, because we have already mentioned previously, and I want to repeat again, that the ideal current ratio should always be 2:1. And when you look at Carrefour here, their ratio is below 1, and the standard or the good one should always be 2:1. Again, 2 here simply means that the company is holding 2 assets for every current liability it has. So a current ratio of 2:1 indicates that the company has current assets that are approximately double its current liability. So we want to compare this with what we have just computed. And then that is the interpretation. Again, here I'm keeping on the standard because it's most important to know that 2:1 is the standard. And then you want to compare what we have in 2020 represented as a factor for Carrefour. It is 0.8187 into 1. So based on this information we have so far, is this a good ratio? Can you say that Carrefour has got good liquidity? In 2021, things did not get any better. Again, it is still very low. So this, now we have seen that, and we have our benchmark. So we, as an investor, as a manager, you have already now been able to extract this information. You have checked, and now you know the healthy liquidity. You can be able to answer this question. Does Carrefour have sufficient current assets to cover its current liabilities comfortably? The answer is no. Why? Because it did, then we should be having a ratio which is closer to 2:1. However, when we look back here, their ratio is even below 1. So does Carrefour have ability to meet its short-term obligation? Again, the answer is no, because if it did, then the ratio which we should have achieved is that of 2:1. So this simply means that the Carrefour would have problems when it comes to paying suppliers. Should the suppliers start demanding their money or meeting its payroll, probably it cannot be able to hire more new people or settling its short-term debt. So this is the information that the current ratio is giving us. Should something happen and it needs to be flexible, it needs to spend some money, maybe there is stock theft, maybe there is damage of stock, maybe it needs some cash to invest in some advantageous venture. Do you think the company has enough liquidity for that? Again, the answer is no, because it has very less. Its current ratio is still 0.8. What about on the other aspect? Investors and lenders. If Carrefour comes to you and asks you for some money, would you be willing to lend it? Does the ratio predict a strong financial position? So again, at 0.8, you do not want to lend this company because there will be some problems in the repayment. It cannot be able to negotiate for favorable credit terms. So we'll move on to learning much about how to extract information for decision making from a financial statement. So you must be familiar with this number. This is 0.8 into 1. That is what we have seen. And then you are comparing with 2.1. And then we have already now discovered that Carrefour does not have a strong liquidity. So as its managers, once you receive this information, what can you do to improve the current ratio of the company? One is to increase its assets.